This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This is the second of two lectures on foreign exchange futures, which is part of the foreign exchange risk management chapter of the paper P4 course notes. It's chapter 18. And in the previous lecture on futures, I explained what futures were, and with a simple example, as I said at the time, a fairly baby example, I tried to make it clear how we'd actually use futures to hedge against the risk of exchange rate movements. However, I did say that that example we did last time was too simple, but there are more what you might call practical problems, and so we'll now look at a fuller example, bringing in those problems and explaining how we deal with it. And so the example I'm going to go through with you is example 9 on page 105 of the course notes. So have a quick look with me. It says it is the 10th of September 2004, so that's today, and we expect to receive $1.2 million on the 12th of November. We know today's spot rate, 10th of September, but the problem as always is that by 12th of November the spot rate could have changed in theory to anything. However, we know the spot on the 10th of September. There are also futures available on the 10th of September. They're listed below. We'll chat through them shortly. And our job, we're going to do two things. We're going to show, first of all, how we'll set about trading in futures to hedge against the risk. And then we'll look and see what actually happens on the date of the transaction on the 12th of November. Anyway, let's go through step by step. What I'm going to do first is something that's not always needed, but it only takes a second. Something I call, it's my words, a reference point. And what I mean by that is to give us something to compare with later. Let's work out how much the $1.2 million would convert to at today's spot. If we were able to convert today, or alternatively, if the exchange rate wasn't going to change, how much would we actually receive? So I'm going to convert at today's spot, and remember today is what? The 10th of September. And so no problem. We're getting $1.2 million. It's $1.5 to the pound, so divide by, and the relevant rate here, we're receiving dollars, and so to convert we'll be selling dollars to the bank. The dollar sell rate is 1.5110, and so at today's spot it would convert to, here we go, £794,176. However, clearly we can't convert at today's spot. As I said, that is just, in a sense, a reference point. What are we going to do? Well, as of today, so 10th of September still, first of all, the transaction itself will leave at risk. So just as with the baby example earlier, we'll leave the transaction itself at risk. We'll convert at whatever the rate happens to be on the 12th of November when we actually receive the money. However, to hedge against that risk, we're going to start a futures deal. And watch carefully what the deal will set up is going to be. And do make sure you set this out nicely in the exam if it's asked. There are so many places you can make a silly mistake, but they'll mark each bit separately. So make sure that this bit, the deal we set up, that you show it clearly. And if one bit has gone wrong, you can still get marks for the other bits. But several things. First of all, have a look at the question. It says futures prices on the 10th of September. You'll see it says dollar-pound contracts, and in brackets it says pounds 62,500. Now I'll come back to that later, but in fact that's because, and I did mention in the last lecture, any futures deal, we have to do it in fixed size contracts. Anyway, we'll deal with that shortly. The next thing though is you'll see there are 3 futures listed, and I explained before there'll be several futures quoted, but all a September future means, it means that future any deal must finish by the end of September. Alternatively, we can go for a December one, and that must finish by the end of December, and similarly a March one by the end of March. And it's our choice. However, remember from that example before that we're going to start a futures deal today, and we'll finish the deal on the date of the transaction, which is 12th of November. So we want the futures to carry on till at least the 12th of November. So September futures are going to be no good, because any deal in September futures we have to finish by the end of September. December one will be okay, because we can finish any time to the end of December, and similarly March next year will be okay. And so either of those we could go for. In the exam, always go for the earliest one that's available. So as I've said, September 1 won't work. We want to carry on to the 12th of November, and so the month we'll go for a December future. In real life, by all means, you could go for a March one if you preferred, but as I said in the exam, go for the first month after the date of the transaction. I'll write that in. There's no need in the exam. Oh, sorry, it's a bit big, that. The first month after the date of the transaction. And so those are the futures we're going to deal in. And the price today, what is it? It's 1.5045. And from now on, the other 2 futures are completely irrelevant. Our deal is going to be a December future. Secondly, you may remember earlier when I was discussing them, with futures deals, you've got the choice. You can either buy the future today and sell it later, or alternatively, you can start the deal by selling today, in which case we buy it later. So we've got to decide, is our deal, as of 10th of September, are we going to buy futures or are we going to sell futures? Now in a minute I'll give you a rule, but let me explain the logic first. You see, we're receiving money. If you look back at the reference point, we're receiving money, and at today's spot, there you are, 7.94. But what is it we're worried about? By November, obviously exchange rate may change. If the exchange rate has gone down, if it goes down to 1.4, we receive more money, which is great. Surely what we're worried about is the exchange rate going up. If the exchange rate went up, for example, to 1.6, when we come to convert, think about it, we'll receive less money. And so, to hedge against the risk, since we're going to lose money on the transaction if the exchange rate goes up, I want to deal in futures where I'll make a profit if the rate goes up. So how can I make a profit? the futures rate at the moment is 1.5045. How can I make a profit from that rate going up? Surely I'll buy today, I'll sell later, and if the rate's gone up, I'll be selling at a higher price, I'll make a profit. So we are going to buy futures. The rule, though, and it's up to you which you find the easiest, and more importantly in the exam, the quickest. The rule is this. If you look at above the futures, it says there are contracts, and in brackets it says £62,500. And therefore we say the contract currency is pounds. The contract size, remember, was 62,500. For the minute, forget the size, but they're quoted in pounds, and they probably will be in the exam. But the contract currency is pounds. And you then say the transaction, and the transaction is converting that $1.2 million, will the transaction involve buying or selling the contract currency? Well, what is the transaction here? We're receiving dollars, so to convert, we'll be selling dollars to the bank, and therefore we'll be buying pounds. And pounds, remember, are the contract currency. And whatever the transaction is in the contract currency, it's the same transaction in the futures. So because the transaction involves buying pounds, we'll therefore buy pound futures. So, one way or another, make sure you are clear. Obviously in the exam you don't want to spend too much time on it, but it is going to be important to have written down, are we going to be buying futures or selling them? But here we'll buy December futures. Finally, though, we need to decide how many we want to buy. Now, of course, how much am I at risk on? I'm at risk on $1.2 million. The trouble is that although I would like to deal in $1.2 million of futures, I've got two problems really. One is it has to be in fixed size contracts, and secondly, the contracts are quoted in pounds. The contracts are £62,500. So we need to work out how many contracts are we going to deal in. And what we do is this. We say, first of all, how much are we at risk on? The transaction itself is $1.2 million. That's the transaction. And in an ideal world, I'd want to deal in exactly $1.2 million worth of futures. But the first problem is that the contracts are quoted in pounds. And so, instead of dealing in $1.2 million, we need to decide what's the equivalent number of pounds we want to deal with. Well, what we're trading on is the price of the future. And so we, in a sense, are gambling, but on a current price of $1.5045 to the pound. Well, gambling $1.2 million at that price is equivalent to how many pounds? Divide by 1.5045, which is the current futures price. Now, I'm not going to waste time actually dividing yet, but however many pounds that comes to is the amount of pounds we want to gamble or deal in However, it must be in fixed size contracts of 62,500. So to get the number of contracts, divide by 62,500. Incidentally, the contract size would be told you in the exam. It could be anything, but it's always the same arithmetic. So the 62,500 is the contract size. And so what does that come to? $1.2 million divided by 1.5045. It comes to £797,000. Divide by 62,500. And I get 12.76. Well, it must be a whole number of contracts. In real life, again, you'd have the choice, dealing in either 12 or 13. In the exam, go to the nearest. And so the nearest will have 13 contracts. And that's the deal we're going to set up. Remember, we're still on today. We're on the 10th of September. And so just to summarize, on the 10th of September, we'll ring the dealer and we'll tell the dealer that we want to buy 13 December futures contracts at 1.5045. And that's all we'll do on the 10th of September. And remember, we don't actually pay any money. I did mention last time the dealer will want a deposit, but we'll get that deposit back later. Otherwise, we don't actually pay anything. In a sense, it's just a phone call. But at some stage, we're going to have to finish that deal, sell those futures, and any profit we'll get, any loss, we'll have to pay the dealer. But that's it. That's all we do on the 10th of September. Nothing else. We then sit and wait until the date of the transaction. Which in our question is what? The 12th of November. Now, of course, by 12th of November, anything could have happened. But if you look back at the question, in order for us to actually illustrate what happens, it tells us that on the 12th of November, the spot rate is 1.51 to 1.519. And the futures price has changed as well. It's changed to 1.5120. And I'll say again, the day we started this 10th of September, we'd obviously no idea what was going to happen. It could be anything. But just so we can illustrate the 12th of November, we'll use the figures in the question. So on the 12th of November, the spot rate, 1.5100 to 1.5190. The December futures, which are the ones we're trading in, obviously, the futures price is 1.5120. Well, now let's see what happens. So don't forget, we're on the 12th of November now. The transaction itself, we left at risk and we convert at spot. So the transaction was how much? $1.2 million. We're selling dollars, the spot rate 1.519. And so it converts to how much? It converts to 789,993. And remember, it may sound childish this, but I always make silly mistakes if I'm not careful. Remember here, we're actually receiving dollars, and so this is a receipt. However, on the same day, 12th of November, we finish the futures deal. And remember, I've said so many times last lecture and again this lecture, it's at the end of the deal that we settle up, that we calculate any profit or loss. And so we'll have our profit or loss on futures. And what shall we calculate it? Although this is the same as the baby example. But we say, first of all, how much were we dealing in? If you look back, our deal, it was 13 contracts. Each contract was how much? It was £62,500. So I'm not going to multiply yet, there's no need, but that is the total amount that we're dealing in. And to work out the profit or loss, the dealer takes the difference, the sell price minus the buy price. Well, remember we started the deal in September by buying futures, and on that day the price was what? 1.5045? We finished the deal on the date of the transaction, so that's when we sell the futures. And on the date of the transaction, it was 1.5120. And so, let's work out the profit. The difference, 1.5120 minus 1.5045, I get 0.0075. But multiply that by the amount we've dealt in. So times 62,500 times 13 comes to 6093.75. And of course the sell price is higher than the buy, and so we've made a profit. Had the sell price been lower, we'd have made a loss and we'd have had to pay the dealer. However, be very careful about one point here. What currency is that 6,093 in? And it's very tempting to say pounds, but do appreciate what we were gambling on was the dollar value of a pound. When we started, a pound was worth $1.5045. When we finished, it was worth $1.5120. We've made a profit of $0.0075 on every pound. So it's just under 1 cent profit per pound. And so the total profit is in dollars.